Hello, everyone. Welcome once again to another real estate podcast episode. And today's topic will be housing reset is becoming widespread. Thanks for attending. My name is SeeWing Yee from the Yee Real Estate Network. I've been a real estate matchmaker, if you will, for several decades. I've assisted many out-of-state mom and pop real estate investors to buy cash flow rental properties, mainly single family homes in many markets in the country. All right, so with that said, let's go over this very, very exciting topic. And just so you know, uh, the the organization I'm referencing is John Burns Consulting. John Burns Consulting is an organization that I've been following for years. They are just as credible, and their list information is just as relevant as information put up by Redfin, Zillow, or National Association of Realtors, or whatever of those mainstream real estate website that we all of us are referring to. So with that said, let's go over the housing reset becoming widespread, and they talk about several very, very important topic, which is critical in today's real estate market challenges. So, all right, investor pullback, rising borrowing costs have driven many investors, including fix and flippers, out of the market, at least short term currently. So let's go over the fix and flip marketplace, the niche market. Something I do not do. I mean, I promote a long-term buy in the whole investment strategy where you could achieve like multiple streams of income using a single family home investment mainly. And because single family home income property over the long term has been one of those you can achieve multi-dimensional areas of making a profit with cash flow, equity appreciation long term, mortgage debt paid down by the tenant, and tax benefits, and using leverage in a way of an amazing 30-year fixed rate mortgage. So those are the key driver for long-term buy and hold. But anyway, but fix and flip are out there always throughout the real estate market history. So right now, these are very, very strong pullback because of the rising interest rate. Because when you have a rising interest rate and the housing, the cost of borrowing for fix and flipper are very, very costly. But when they finish flipping their homes, they have to try to sell their home at a higher market value at a what's that word, at after rehab value, right? After anyway, but as we know, the market housing prices have seen a slowdown as a result. After repair value or may not necessarily go any higher, may even decrease, given some markets are having their prices being lowered, right? So you know what I mean. So as you can see, the percentage of fix and flip acquisitions is no longer feasible due to the high cost of short-term lending in the fix and flip industry right now. So as you can see on the chart, prior to this year, because of the skyrocketing rising of the home prices and the extreme lower interest rate. So during the pandemic, flippers, if you will, have done very well in many hot markets. But now, as you can see, not only the flippers are pulling back, they're not doing as many acquisitions on a fix and flip in many markets, but the institutional investors are also pulling back on their aggressive acquisition as well. So let's go over. See, rental home pullback. Rising borrower costs have also slowed the single family rental market, according to here as well. And let me see what's the takeaway on this particular paragraph. So Yeah, that's pretty obvious, right? Because of the rising borrowing costs, many risk investors are again the profit margin, the yield are not as high because again, once again, the borrowing cost, the loan at a higher interest rate, they just not gonna get the yield that they look for. So at least temporarily, in some markets, the institutional investors, Wall Street, the hedge funds, if you will, they are slowing down in some of their markets, not all, right? And another big challenge, which will exacerbate the housing supply, is that the home building confidence level has lowered because home builders they depend on rising demand by buyers to justify them constructing new homes. Now that the confidence level of the home buyers public has decreased dramatically, right? Some recent study indicates that like 70% of the nation's potential home buyers they are not having any confidence to buy homes at these days due to the challenges that we are facing. Home builders are no different, right? Home builders no different because they, in fact, a lot of their inventory of homes that already finished building, they'll try to sell them because they are home builders at these days right now in the middle of the year, August, September, 2022. They try to get rid of the existing inventory because they are closing their books. Their year-end financial statements are ending in the third quarter and fourth quarter of this year, so they need to get sell those inventory since the demand has a pullback in the market. So they are offering a lot of potential home buyers a lot of incentive, like lowering their prices, provide some incentives, providing closing costs to the buyers and few other things, right? And so as a result, because of the lower demand, many nationwide builders are not going to construct any more homes, right? Because the demand is just not there, at least short term. So because the supply of inventory depends on the new home constructions to continue to provide into the marketplace. If they pause construction of new homes, if they not uh, uh, initiating the permits to build new homes, if they pause right now, look at the longer term effects of the housing supply inventory, right? If a home build, if sellers, people that own homes, if they not selling right now, we have seen some trends that they are many home sellers are keeping their homes off the market because they have such a great interest rate. They want to lock in interest rate. They're not going to sell. So the resale side of the market are not selling, and the new builders are not building, right? So look at long term. A lot of us are thinking. Many of us right now we have this short term memory. We have this like uh, we think for the moment, right? We think in a very narrow way right now because we are so concerned about so many negative things going on in the real estate market. But the long term, the consequences of long term, with a lack of new home construction and the home sellers are not selling, we're going to have potentially an extreme, even lower supply of homes than we have seen in recent years. So housing supply will continue to be very challenging. So if the demand ticked up late this year because of the most buyers are out of the summer vacation mode, some people still can afford it to buy, albeit at a lower purchase point because of the payment will be higher based on the higher interest rate. So I see some more activities gonna come back. Buy will buy toward the last quarter of this year. That's my prediction. As long as the interest rate stays the same, uh, 5.5%, something like that, then I could see more buyers that are coming to the market than it has happened so far this year. So But this article go on to say, but on apartment booming as well, apartment operators, no, they feel the same pain, and because of the rising mortgage rates and it eats into the profit. You know, everything is interest rate sensitive. We all know that by now. So the Federal Reserve is such a have a controlling interest in how the economy works. It's just amazing how they control the economy so much. So anyway, I think that's pretty much it I have to say. And in conclusion, according to John Burns Consulting, rising rates hurt most housing industry businesses across the board, from rental homes to home ownership to every business involved in a home. Look, look, this article seems like doom and gloom, right? Seems like everybody's losing in this current market condition. In my personal opinion, there are winners and losers. Okay, I hate to be this blunt. The losers are, the renters cannot buy or do not want to buy because of the fearful situation, and they continue renting. If they continue renting, they are paying skyrocketing rents. We have been hearing all across the country, certain many markets, they have like a double, triple, quadruple digit in rental rates increases. This is mind-boggling, and this is a national crisis. Renters are paying so much higher rent than ever before, skyrocketing rent, record numbers. So I could say that renters these days are the losers in this real estate market because they just throw money away, paying the rent to rich landlords that are the recipient of higher interest rate increases, so they receive more cash flow. And of course, that's what's happening. Now, the winners, okay, I would say the winners, believe it or not, the winners are mom and pop real estate investors, especially for those mom and pop real estate investors that want to buy affordable homes, they buy low cost homes in affordable markets in the country, right? And take advantage of the skyrocketing rents or renters paying the landlord. So that is a current best profit model in this challenging market. So the winners are real estate investors. They're buying investment properties whereby they are, hate to say this, they are taking advantage of the skyrocketing of rents. So the renters are paying a lot more rent on the rental property that they have, that the investor has, and those high skyrocketing rents are able to make landlords and real estate investors rich because the landlord and the real estate investors are getting higher cash flow, even though their cost of borrowing is high as well, right? But at the end of the day, when you do the numbers, when you buy at an affordable market, around South and Southeast, just so you know, and lower price homes, single family homes, preferably anywhere from 100,000 to 300,000. If we could entice a tenant to pay a skyrocketing rent to the tune of $1,000 monthly rent on a $100,000 rental property, or $2,000 monthly rent on a $250,000 rental property, a landlord will profit from this rising rental profit, in addition to the rising appreciation. All the markets are still appreciating, so that's really good. So anyway, as a reason, so the winners are the mom and pop investors that have the ability to own one or more rental property and take advantage of this skyrocketing of rents, so they can achieve more cash flow, more higher yield, higher rental value ratio, and on top of that, more appreciation and what have you. All right, so if you want more information, please click on my website. You can submit your email into our database, and you will become a free member of our organization, the Yee Real Estate Network, and you'll be able to receive more in real estate investing information that as a member you're able to have access to. And If you please click the like button on this video, and also subscribe to my channel. And so anyway, and we will have weekly videos about all aspects of the real estate markets for everyone. So our goal is to provide ongoing great content or relevant in the changing dynamics of the real estate market. All right, thank you so much. This is SeeWing Yee from the Yee Real Estate Network. Thanks for attending. I will see you on the next video. Have a nice day. Bye-bye.